Should we enjoy the day, Rick? Because the market has picked up on this improving mood music, and what it's meant, it's been one part of the story, but what it's contributed to is much higher Treasury yields relative to where we were 2 weeks ago.
I mean, last week was unbelievable. I mean, last week, across the curve, the movement out in rates, you took a lot of the fundamental underpinnings for why we have lower rates out. The China trade deal being a big part of it. By the way, the anticipation the ECB was going to over-deliver was big. And by the way, there's a lot of data showing the U.S. economy is not going into recession tomorrow. That suggested, gosh, having the 10-year at 145 didn't make a lot of sense. The size of the move was significant. Putting money to work here today feels a whole lot better in the Treasury market than it did a week and a half ago.
Technical correction or sustainable trend?
So I think we're going to be in a range. I mean, I like the front end of the yield curve. Now being able to buy the front end at 170, where there's an asymmetric risk reward, you got a Fed that's easing, and you've got, if you have significant growth, you're going to back up a little bit. Yeah, but you carry well in the front end of the curve, and if we slow down, the Fed's going to go more aggressively. So I like putting money to work in the front.
Is that what you were doing last week?
Yeah, I'd say there was a fair amount of that, and as well as carrying into this week in terms of the front end, and quite frankly, the very back end of the curve is interesting, given that all of a sudden you got the back end back to levels. Although 235 is not exactly exciting in the 30-year part of the curve, it's a whole lot more exciting than 190 was.